Welcome to today's explainer. We're literally hitting the whiteboard today to map out a really safe, passive income strategy using options. Most retail investors treat options like, well, lottery tickets. They buy them with this blind hope of just striking it rich. But today, we are completely flipping the script. We're totally done buying lottery tickets. Instead, we're going to act like the casino. So think about this for a second. What if I told you that you could get paid cash today simply for making a promise to buy a stock you already want to own at a discount? I know it sounds like some kind of sneaky Wall Street trick, right? But it's actually a very established strategy. Instead of playing the lottery, we're stepping into the shoes of an insurance company and we're collecting cash up front. Let me show you how. Let's jump straight into section 1, the real estate analogy. Forget Wall Street for a minute. To really wrap our heads around how selling a put option works, let's just erase all that confusing financial jargon. Let's draw out a mental whiteboard model using something we all understand, real estate. Picture this. We're sketching out a house. Your friend owns this house and it's currently worth $500,000. But they're super worried the market is going to crash. So you step in with an offer. You sign a binding contract promising to buy their house for $450,000 anytime in the next month, no matter what happens to the market. Now, in exchange for giving them that peace of mind, your friend pays you $2,000 in cold hard cash right now. Boom. You pocket that $2,000 immediately. Okay, so here is the absolutely crucial point where this connects straight back to the stock market. That $2,000 you just pocketed on our whiteboard, in the financial world, that is literally called the premium. When you sell a put option, you are effectively selling stock market insurance to another investor who's terrified their stock might crash. And just like Geico or State Farm, you get paid a premium upfront for taking on that risk. The best part, the cash is sitting in your account the absolute second that contract is signed. Moving right along to section 2, 2 possible outcomes. What exactly happens when the end of the month rolls around? Well, let's map it out. If the market stays hot and the house is still sitting pretty at $500,000, your friend is definitely not going to force you to buy it for less. They just walk away, the contract naturally expires, and you keep that $2,000. Free money. But what if the worst happens? The market crashes and the house drops to $400,000. In that case, your friend is absolutely going to exercise the contract. You are now legally forced to buy it for the agreed upon $450,000. But remember, you still keep your $2,000 premium. Plus, you now own the asset at a massive, massive discount from where it started. Now for section 3, the scorecard. Let's look at the strengths, weaknesses, risks, and rewards. It's time to separate the reality of the trade from the fantasy. Let's look at the goods column first. You get instant cash paid up front, and it basically acts like a limit order to buy the dip. You get to literally name your price for a stock. But we gotta look at the bads column too. Your upside is strictly capped. If the stock just skyrockets to the moon, you only keep that initial upfront premium, nothing more. And the absolute biggest risk? Bag holding. If the company crashes all the way to zero, you're still legally obligated to buy those shares at the higher agreed price. Ouch. But hey, despite those risks, this brings us to the ultimate reward of this entire strategy. It gives you a phenomenally high probability of success. Seriously, think about traditional investing. You buy a stock and you literally only win if it goes up, right? But when you sell a put option, you are getting paid to wait. You actually win in 3 distinct directions. You win if the stock goes up, you win if the stock stays completely flat, and get this, you even win if the stock drops just a little bit, as long as it stays above your contract price. It's wild. Which brings us to the absolute golden rule of our whole whiteboard session today. Listen closely to this one. Never ever sell a put option on a trash stock just for the quick cash. Only do it on high-quality companies you actually want to own for the long haul. If you go chasing juicy premiums on terrible, fundamentally broken companies, you're going to get stuck bag holding a worthless asset. But if you do this with great companies you'd be thrilled to buy at a discount anyway, well, that's when the strategy becomes incredibly, incredibly powerful. So let's quickly recap everything we've drawn out today. Selling a put simply means getting paid cash today to promise to buy a stock tomorrow at a discount. If the stock stays up, you keep the cash. If it drops, you buy the stock you already wanted. It's just a fantastic, systematic way to generate income and build a portfolio. So as we wipe the whiteboard clean and close out this explainer, I'll leave you with this final provocative thought. Take a look at the companies you interact with every single day. If you were completely forced to own just one of them for the next 10 years, what stock would you want to buy at a discount? That might just be the absolute perfect place to start. Thanks for hanging out with me on this explainer, and keep learning.